Ever pondered why closing entries are so significant in accounting? Well, it's because they serve as the bridge between two accounting periods, ensuring a smooth transition and accurate financial reporting. Let's delve into the details. Closing entries, in essence, are journal entries made at the end of an accounting period. Their primary role is to reset the balances of temporary accounts, such as revenue, expense, and dividend accounts, to zero. This clearing process is crucial to prepare for the next accounting period. To make closing entries, each revenue account is debited and the income summary account is credited. Subsequently, each expense account is credited and the income summary account is debited. The balancing act doesn't end there. The income summary account is then closed by transferring its balance to the retained earnings account. Any dividends that have been declared are closed directly to the retained earnings account. With closing entries completed, the next step is preparing the post-closing trial balance. The post-closing trial balance lists all the permanent accounts and their balances after the closing entries have been made. The aim here is to ensure that only permanent accounts with balances remain open for the next accounting period. Doing this checks that the closing entries were made correctly and that the all-important accounting equation, assets equals liabilities plus equity, is balanced. Now, there's another step in the accounting cycle that we haven't touched on yet: reversing entries. These are optional, but can greatly simplify the accounting process. Reversing entries are journal entries made at the start of a new accounting period. Their purpose? To reverse the effect of certain adjusting entries made in the previous period. They're typically used for accruals and deferrals, like prepaid expenses or unearned revenue. By resetting the account balances to their original state before adjusting entries were made, the subsequent recording of transactions in the new period is greatly simplified. In summary, closing entries, preparing the post-closing trial balance, and making reversing entries form key steps in the accounting cycle. They ensure accurate financial reporting, maintain proper account balances, and facilitate an orderly transition between accounting periods. Accounting is a world of numbers and balances, debits and credits, and these processes are the invisible gears that keep that world turning smoothly.